So, Nvidia reports another monster quarter. They beat on revenue, they beat on margins, and they gave solid guidance for the future. And what does the stock do? It drops. You probably saw that happen right after the bell and thought to yourself, what gives? Did I miss something? Well, if you've watched my last video, you'd know there's a simple answer. Wall Street greed was expecting a massive beat, but only got a regular one. But the real story, the one that matters for your long-term thinking, is buried in the details of their earnings call. Details that suggest the market is completely misreading the situation. And that's what we're going to unpack today. Alright, for those of you who are new here, and there are a few of you, which is nice, my name is DataCat, and yes, I'm the one who traded in a cubicle and a soul-crushing commute at a Fortune 50 company for, well, this. A microphone and a laser pointer for my actual cat. I spent years as an average analyst, staring at spreadsheets until I ran out of coffee, trying to separate the signal from the noise. I used to drink like at least 4 cups a day. Now I do it for you. And right now, just like my cat knocking a glass off the counter, the market's reaction to Nvidia's earnings was swift, a little dramatic, and probably not based on a deep understanding of the situation. But again, that's all well expected before the earnings were released. So let's look at the scorecard. Let's put the expectations right next to reality. First up, revenue for the second quarter. The street was looking for around $46 billion. Nvidia came in at $46.7 billion. That's a clear beat, not a huge one, but a beat nonetheless. Next, gross margins. The expectation was about 72%. They delivered 72.7%, another beat. And management doubled down, saying they still expect to hit the mid-70s by the end of the year. So, the business is not only growing, it's becoming more profitable. Now, the big one, the one metric everyone was watching, guidance for the third quarter. This is where the story gets a little twisted. The consensus was that a guide around $53 billion would be seen as okay, but a little bit more like $54 billion would be even better, a cautiously good case scenario. Nvidia guided for $54 billion, which is solidly in line with this scenario. Now, on paper, that's a strong number. It's crossing the excite the market zone. It shows they have incredible confidence in the transition to their new Blackwell chips. But the market, well, like I mentioned in the last video, the market had let its imagination run wild, with whispers of $55 billion or even higher. So, a $54 billion guide felt to some like a disappointment. And what about China? With all the geopolitical tension, the expectation was that management would play it safe and completely exclude any potential revenue from their specialized H20 chips from the guidance. And that's exactly what they did. That $54 billion number has zero H20 sales baked into it. But then they added a little something extra. They mentioned that if things clear up, they could ship anywhere from $2 billion to $5 billion worth of those chips in the third quarter alone. If you add this number to the $54 billion revenue guided, it's basically a hidden call option on the quarter's performance. So if you just look at the surface, you see a small beat and guidance that was merely great instead of impossibly fantastic. And that's why the stock traded down after hours. But here is what the headlines are missing. Here is what you need to understand. First, the transition to their new server racks, the NVLink systems, is going smoothly. This was the single biggest risk going into the quarter. The bear case was that the switch from their old Hopper chips to the new, much more complex Blackwell systems would cause delays, an air pocket in production. That's not happening. The company stated, and I'm quoting here, "The transition to the new GB300 rack-based architecture has been seamless. Today, full production is underway. They are already producing approximately 1,000 of these incredibly complex racks per week. This is huge. It means the supply chain is working, the manufacturing is scaling, and the biggest operational risk is now off the table." Second, let's address the idea that spending on AI from the big cloud providers is slowing down. Because this is where the negative story really took hold and could have ruined your entire tech portfolio. The bear data point, if you want to call it that, was very near term. Q2 data center revenue came in just slightly below the highest estimates. That, combined with a guide that, while strong, didn't absolutely crush the loftiest whispers circulating on the street, was enough for some to start framing it as a deceleration. Frankly, that's what the after-hours sell-off of about 3% was all about. It looks far more like a reset of positioning and expectations, rather than a fundamental change in the actual spending cycle. Because the idea of a real slowdown was directly refuted by management. Jensen Huang himself pointed out that the capital expenditure from just the top 4 cloud companies has doubled in 2 years. It's now at a $600 billion annual run rate. Let that sink in. $600 billion. He then went on to expand the total addressable market for AI infrastructure to $3 to $4 trillion by the end of the decade. Unless he is blatantly lying, I don't see a story about a slowdown here. But a story about a multi-year build-out that is still just getting started. And finally, the most important point. The thing that I think most people are missing. Nvidia's competitive moat is getting wider, not smaller. Everyone is focused on competitors trying to build a better GPU. But Jensen spent a lot of time explaining why that's the wrong way to look at it. Nvidia isn't a chip company anymore, they are an AI infrastructure company. To build their next-generation Rubin platform, a customer needs 6 different, highly specialized chips that all have to work together perfectly. You need the Vera CPU, the Rubin GPU, the CX9 SuperNIC, the NVLink switch. He then detailed their 3 levels of networking that tie everything together. It has competitors looking on from a distance, like a cat judging your life choices from the top of the refrigerator. They are solving the entire data center problem, while others are still trying to perfect just one piece of the puzzle. So when you put it all together, the narrative of a slight disappointment just falls apart. The fundamentals are not only strong, they're accelerating in the areas that truly matter for long-term growth. Alright, so we've established the fundamental story for Nvidia is solid. The business is executing, demand is massive, and their competitive advantage is widening. But a good story doesn't always mean the stock price goes straight up, at least not in a neat line. This brings us to the technical picture, what the chart is actually telling us. And again, the truth is, the drop after earnings wasn't a surprise if you were watching the positioning. It's a classic case of what traders call a good print, but a crowded long. Think of it like this. Everyone who wanted to go to the party was already there. The music is great, the food is good, but there's no one new left to come through the door. So some of the early arrivals decide to take their coat and leave. That's what happened here. So many investors were betting on a positive result that when the good news finally arrived, there were more people looking to sell and take profits than there were new people looking to buy. Before the report, I was looking for a potential pop that would quickly fade, with a key area to watch between $174.50 and $177. And that's almost exactly where the stock landed after hours. The fundamentals are intact, so a controlled dip into this zone is something to watch closely. So where does that leave us now? If we look at the market structure, the primary trend is still bullish. This is a stock that has been in a powerful uptrend, but the momentum is decelerating. Some of the key indicators I watch are showing that the buying pressure has been weakening over the last few weeks. Think of it like a marathon runner who is still in the lead but is clearly getting a bit tired. The risk of a pullback or some consolidation is becoming significant. And leading into the report, the chart was signaling that a big move was coming. I noticed I wasn't explaining enough last time. The squeeze I mentioned happens when a period of low volatility is followed by a period of high volatility measured by comparing 2 indicators, like a cat when it crouches down, tail twitching. You know it's about to pounce, you just don't know if it's going for the toy or your ankle. Earnings was the event that made it pounce, and it pounced down for now. So let's map out the key levels, the specific prices you should be aware of. The ceiling or resistance is at the 52-week high of $184.48. To see a real continuation of the uptrend, the price needs to get above that level and stay there. There's a small but important pivot area at around $180.40. If the price can't hold above this little zone, the very short-term picture starts to look weak. The 20-day EMA, which some traders would be looking at, is around $178. If we do see more selling, the next levels of support to watch are around $172, and then a stronger zone with the floor at $168. So here are a few scenarios I'm watching. First, the bullish scenario. The stock reclaims and holds above $180.50 on good volume. This would suggest that buyers are absorbing all the selling and would increase the odds of another test of the all-time highs. Second, the neutral scenario. The price stabilizes in that zone we talked about, between $174.50 and $177. If it can hold here without too much selling pressure, it would be a constructive sign of digestion before the next move. And third, the bearish scenario. The stock loses $174.50 on high volume. I repeat, it only counts if it's high volume. This would suggest the sellers are in control and increases the probability of a deeper move down towards below $170 level. Looking ahead, the price won't move in a vacuum. There are a few key catalysts to keep on your radar. Any news on China export policy for those H20 chips could be a major factor. We'll also be watching for any updates on the Blackwell and NVLink server ramp, and of course any commentary from the big cloud companies about their spending plans. So, to put it all together, the long-term story from the company looks strong, but the chart is telling us to be patient. The after-earnings dip is a logical reset, not a reason to panic. Thanks for watching. If this breakdown was helpful, please hit that subscribe button. It tells me I'm on the right track and helps me keep doing this. I'll see you in the next one. Alright, DataCat out. Stay sharp and stay safe out there.